I think the way you want to think about this is a bit like a warning shot. Going into this, you had like 1 or 2 months where positioning and sentiment was at the upper end of the range. People were bullish. Our risk appetite indicator was actually at one of the highest levels since the 90s, if you take out gold. And we were flagging that. We were actually worried about a bit of a correction because at the same time, while you had bullish positioning, momentum on the macro was a bit weaker. You had like a negative macro surprises in the US for like 1.5 months before that. And you actually started to see Europe and China macro surprises turn negative as well. So I think the actual trigger, of course, was that famous NFP print and obviously what happened in Japan and the carry trade unwind. But I think it did highlight to the market that we're dealing with a macro backdrop that's maybe a bit less friendly than hoped. And I think what's concerning now is how quickly the market has gone back to where we were before. And we can discuss that, but that certainly shows that we're sadly nearly back to the same problem we were at a month ago.
So clearly, with that wonderful trader hindsight, buying the dip was a fantastic trade. Hindsight's done very well on that trade, as hindsight always does.
Yeah.
But now, where does that leave us? Because we're roughly back to where we were in many cases. Where does that leave risk appetite with your clients at the moment?
Yeah, so what happened on August 5th and around there was obviously a huge technical overreaction, and I'm sure this was discussed a lot of times here on television, and everybody knows by now the drivers behind it, but certainly having the VIX at 65 was not commensurate to what you actually saw in the market and the economy. So that was a buying opportunity, but the challenge you have now is that equities and risky assets completely reversed and are back to where they were before. What I find quite interesting is risk appetite is not back to where we were before. And what actually happened is that the safe assets, bonds, gold, yen, Swiss franc, they've actually not sold off. So they're not back to the levels where we were at. So there is not the same complacency, I would say. What I also find interesting is that the VIX has not reset to the levels where we were before. The same we can actually see in credit implied volatility. So what I would say is the good news is, while the S&P is back to where we were before, the complacency isn't. We're not at the same kind of extreme bullish sentiment and positioning.
So just to add then, what does that mean for how good an indicator is are bull market indicators and sentiment indicators? How good an indicator are they for where the market goes next? Because clearly they missed the downtick we just talked about 3.5 weeks ago. How good are they going forward now that your clients are a little bit more cautious?
Yeah, I mean, what we find is that sentiment and positioning indicators, they always work best when they're really bearish. So when everybody's bearish, you want to be bullish. And that was a bit the case on August 5th. In a very fast manner, you created good asymmetry because people were getting too bearish too quickly. Now we're back to more medium levels, not as high as we were 2 months ago. The signal there becomes a bit more murky. It's much more down to the momentum on the macro. So it really now depends on the growth inflation policy mix, as it does most of the times in the market. So now we will have to see how does the US growth evolve, how does policy react to it, and how does inflation allow policy to react to it. That will be what we'll deal with in the next few weeks. And then obviously you have on top of that the elections. That's a big event. And that is also interesting because over the summer we learned a lot with the elections, a lot of new things. But I feel it's not completely assimilated in the market. Because people were on holiday. And now as we come back, there will be much more questions being asked. How could a Harris-led government look like? Because that shift happened around that time.
Yeah.
Christian, the last time we spoke, actually, you had spoken a lot about needing sort of a balanced portfolio, actually, as well. I mean, are you still on that mode right now? Is that where you'd see things? Or do you think a little bit more defensive, considering moderation in rates, etc., the environment we're kind of facing now?
I mean, a good memory, and actually a balanced portfolio did phenomenally throughout this. If you think about it, the bond market buffered most of that drawdown. If you look at a 60-40 portfolio, it was a blip. You know, the max drawdown, I think, was 2% for the US or the European balanced portfolio. So in other words, the bond market buffered equity as we were hoping it would. The challenge is now that you have quite a bit of pricing in the bond market for cuts already. the market has a decent probability of a 50 basis point cut and at the first cut. So we're dealing with market pricing in the safe assets and the bond market that is already a bit more dovish. And that means that the buffer you have from the bond market might not be as good in the near term. Yeah. If you look on a more medium term, we still think that a 4% 10-year yield gives you a decent buffer for equities in the medium term in a 60-40 type portfolio. You might not fall back to 2 or below like you did in the kind of deflationary QE times, but you should easily fall like 100 basis points or more to kind of buffer equity. So I would say, considering that you don't have as much buffer currently from bonds, tactically maybe you want to be a bit careful about your risk portion, especially after this run. There's different ways to deal with this. Either you trim it a bit, you could trim, or you kind of create alternative diversifiers. Could be liquid alternatives, it could be option overlays, things like that.